Welcome to this lesson dedicated to the money market, a fundamental pillar of the modern economy. Understanding this mechanism is crucial for anyone wishing to delve deeper into financial and macroeconomic dynamics. We will analyze its functions, structure, and its impact on our daily lives. The money market is the nerve center of the modern economy, influencing every aspect of economic activity. It is where the liquidity needs of all market participants converge. Its efficiency is directly related to a country's stability and economic growth. This market is essentially the meeting point between supply and demand for money. Through it, money is allocated among economic agents, facilitating trade and investment. Understanding this interaction is essential for every student or investor. A thorough understanding of this system is essential to understanding the functioning of the economy as a whole. Decisions made within the money market have repercussions on interest rates, inflation, and access to credit. Their influence is widespread and direct. Indeed, the decisions of central banks, key players in this market, directly impact the daily lives of each of us. They influence the cost of money, the prices of goods and services, and the ability of families and businesses to invest. These policies shape our economic future. To delve into the market, we must first define what money is. It is any good widely accepted by the community as a medium of exchange, a unit of account, and store of value. This general acceptance gives it its economic function. Money is primarily a medium of exchange, overcoming the inefficiencies of direct barter. Thanks to it, it is no longer necessary to find a double coincidence of needs to carry out a transaction. This greatly facilitates trade. Money also serves as a unit of account, providing a common yardstick for measuring the value of goods and services. It allows us to compare the value of very different items, simplifying economic decisions. Every price we see is expressed in monetary terms. Finally, money acts as a store of value, allowing purchasing power to be transferred over time. People can save money today to spend it in the future, maintaining their purchasing power. This function is crucial for long term economic planning. There are several main forms of money, each with specific characteristics. Understanding these distinctions is essential to analyzing the money market. They reflect the evolution of the financial system. Fiat money, issued and guaranteed by the central bank, is one of these forms. It includes the banknotes and coins we use every day. It is recognized as legal tender and cannot be refused for debt payment. Alongside this, we find bank money, created primarily by commercial banks. It manifests itself in the form of bank deposits, generated through the lending mechanism. When a bank grants a loan, it credits an account, creating new money in the form of deposits. The supply and demand for money are the forces that determine the price and quantity of money in circulation. These dynamics are fundamental to understanding the equilibrium of the money market. Their interaction defines the value of money. The demand for money refers to the amount of money that individuals and businesses wish to hold in liquid form. It's not a question of the demand for wealth, but rather of the preference for liquidity over other assets. Money holding decisions are influenced by several factors. A primary factor is the general price level in the economy. As prices rise, more money is needed to purchase the same goods and services. This pushes people and businesses to hold larger amounts of money. Disposable income also influences the demand for money. Higher income typically implies higher spending, thus a greater need to hold money for transactions. The correlation between income and money demand is direct. Interest rates are another crucial factor. When interest rates are high, the opportunity cost of holding liquid money increases, as potential returns are foregone. Consequently, the demand for money tends to decrease. Conversely, low rates incentivize holding more liquid money. There are several main reasons why economic agents want to hold money in liquid form. These reasons help us understand the drivers behind the demand for money. Each reason responds to different needs. The transactional motive drives people to hold money to make current and scheduled payments. It's the currency needed for everyday purchases, bills, or salaries. This constant flow of transactions requires liquidity. The precautionary motive involves holding on to money to cover unexpected expenses or emergencies. It's a form of insurance against future uncertainty. This financial cushion provides a certain financial security. Finally, the speculative motive refers to the choice to hold money while waiting for more favorable investment opportunities. Investors may prefer liquidity rather than locking up funds in assets with uncertain or expected declining returns. This is a waiting game. The money supply, on the other hand, is defined as the total amount of money in circulation within an economy. This quantity is controlled and managed by a single authority. Its expansion or contraction has significant macroeconomic effects. Control of the money supply falls primarily to the central bank of a country or currency area. Through specific instruments, the central bank can increase or decrease the quantity of money available. Its management is a key element of economic policy. The banking system plays an irreplaceable role in the creation and distribution of money. Its operations are closely intertwined with the decisions of the central bank. Understanding how it works is vital. Commercial banks, like the ones we use every day, are central players in this system. They accept deposits from customers and extend loans to individuals and businesses. This dual role makes them essential financial intermediaries. Through lending, commercial banks are able to implement the process of bank money creation. When a bank grants a loan, it credits the borrower's account, increasing total deposits. This multiplicative process is fundamental to the money supply. The European Central Bank, or ECB, is the supranational institution responsible for monetary policy in the Eurozone. Its mandate is to ensure price stability while contributing to sustainable economic growth. It is a pillar of European integration. The ECB exercises direct control over the money supply, using a variety of tools to influence the amount of liquidity in the system. Its decisions have a profound impact on financial markets. This control is essential for economic management. Another crucial task of the ECB is controlling key interest rates. These rates influence the cost of borrowing for commercial banks, which in turn pass them on to households and businesses. They send a powerful signal to the economy. The ECB's primary objectives are price stability, to maintain the euro's purchasing power, and supporting economic growth. These two objectives are pursued through careful calibration of monetary policy. Their alignment is ongoing. Monetary policy is the set of actions taken by the central bank to influence the economy. Through the management of money and credit, it seeks to achieve specific macroeconomic objectives. It is a powerful tool for economic management. The main tools available to the central bank are diverse and complementary. Each has a specific impact on the money market. Their combination allows for flexible management. A key tool is setting benchmark interest rates, such as the main refinancing rate. By changing these rates, the central bank makes it more or less expensive for commercial banks to borrow money. This influences the rates charged to end customers. Open market operations are another powerful tool. The central bank buys or sells government bonds or other financial assets on the market. By buying bonds, it injects liquidity. By selling them, it withdraws it, altering the money supply. Finally, banking regulation and reserve requirements are indirect instruments. By imposing reserve requirements or supervising banks, the central bank influences their ability to lend money. These rules ensure the stability of the system. The financial market is closely linked to the money market, albeit with different functions and instruments. Often the two are confused or perceived as separate entities, but they operate in close synergy. Their interdependence is undeniable. The financial market is where medium and long term financial instruments are traded. Here, investors buy and sell rights to future cash flows or ownership interests. This market is crucial for long term financing. Stocks are a primary example of a financial instrument traded on this market. They represent ownership interests in a company, conferring rights to its profits and assets. Buying shares makes the investor a shareholder. Bonds, on the other hand, are debt securities issued by companies or governments to finance their activities. Buying a bond means lending money to the issuer in exchange for interest and the repayment of the principal. They represent a term loan. The spread is an important concept in finance, often used to assess credit risk. It is defined as the difference between the yields of two financial assets. A wider spread suggests greater risk for the asset with the higher yield. Understanding these notes on the financial market is of great importance. It allows us to place the money market in a broader context and to grasp the interrelationships. Both are essential components of the economic system. In short, the money market is a dynamic and vital ecosystem for the global economy. It regulates liquidity, influences interest rates, and supports growth. Its careful management is crucial to economic prosperity. We explored the nature of money, the forces of supply and demand, and the crucial role of the banking system and the ECB. We also touched on the connections with the broader financial market. Every piece of this puzzle is interconnected. For students and investors, this introduction should provide a solid foundation for further exploration. Mastering these concepts is an essential step toward greater economic awareness. Thank you for your attention.